My name is Jake, welcome to the channel. In today's video, we're going to do another Review My Pie video. For those of you that are new to the channel, what I did is I created 3 series here on the channel. So I focus on 3 series. The first being dividend growth investing. That's all things dividend, investing for all you dividend nerds out there like myself. Another series that I created was Review My Pie, where I review subscriber portfolios. And then the third series here is on financial independence. For those of you that are new to the channel, I'm striving to achieve financial independence in my early 40s. I'm currently now in my mid 30s. I've been investing for over 10 years. I've made a lot of money. I've lost a lot of money. I've tried many different things. And I created this channel to help new investors or beginner investors learn about dividend investing. That's what it's all been about. I don't sell a course. I don't do anything like that. It's just me sharing what I've learned along the way. So in today's video, we're going to focus on 4 portfolios. In the past, I focused on 6, and I've gone into pretty good detail in previous videos. But I think that in certain portfolios, I've actually ended up rushing through it. And so I want to try something a little bit different today, where I go into more detail in each individual portfolio and add a little bit more perspective. Leave me a comment below if you would prefer it this way, where I spend a little bit more time on each individual portfolio, or if you would be more interested in seeing more portfolios, but just keep it more high level. So I'd be curious to hear what your thoughts are. All right, the first portfolio is from an individual that is 22 years old. All of them, I'm unsure of the location. They didn't specify their location in the email. Portfolio 2 is 47 years old. Portfolio 3 is 33, and portfolio 4 is 34 years old. I'm going to leave a timestamp in the description below to each of these portfolios. And as always, I don't pre-script what I'm going to say. I don't actually look into the portfolios before reviewing them. And so this is as live as I can make it. And as always, I'm not a financial advisor, so don't take what I'm saying as financial advice. And lastly, if you would like me to review your portfolio in a future video, I have my email in the description below. You can shoot me over an email. I ask that you kind of share a little bit of context so I can personalize it and tailor it to you. For example, your age, where you're at. Are you in the US? Are you abroad in Europe or in Canada, or wherever you're at, as well as your goals. So when I mean goals, when are you looking to use the dividends to pay for your living expenses? So that's what I really mean by goals. And also how much you're funding the portfolio each month. All right, let's take a look at the first portfolio. The first portfolio is from Richard. Richard writes, "Hello, my name is Richard. I've been investing for a couple months now. I am 22 years old, a student at work, and work as a barista part-time. I have a Roth IRA that only includes ETFs. I'm mainly looking for a review on my taxable dividend growth account," so you're on your taxable account. "My goal is to have stable passive income towards the later part of my career. Eventually, I'd like my dividends to help with my monthly expenses. I have a Roth IRA for retirement. As I work part-time along with school, I'm only able to contribute about $150 into my M1 Finance portfolio, as well as $150 into my Roth per month. As my income increases, once I have a career, my contributions will increase as well." Okay, great. So it looks like you also have some questions here. Let's read off some of your questions. As well as your own opinions and review, I do have 3 specific questions if you don't mind. Okay, so is my portfolio 46 positions diversified enough? Should I have more or less? Would you make any changes to my target percentage for any sectors or stocks? What would be an ideal overall dividend percentage yield range? I know dividends may increase or decrease slightly per year. I've invested into strong dividend growth stocks. For the most part, I could start with a lower yield and it'll increase slightly year after year. Any opinions and criticisms is welcomed. You can feature my video and okay, perfect. All right, so I guess let's take a look. Let's see if there's any questions that I can answer first here. So 46 stocks. I think, or holdings, that's probably including ETFs. I think that's fine, 46. I get asked this question all the time, and I want to be very transparent. My portfolio that I share here on YouTube, I'm a dividend nerd. Like, I spend countless hours a week reviewing my portfolio. I really enjoy it. It's my hobby. And so I know that that's not going to be the case for everyone. So I always recommend that you start out slow. If this is not something that you're passionate about, you want to put it on autopilot, make it as simple as possible. Now, with M1 Finance, it's really great because it allows you to do exactly that. It automatically rebalances based off of your target allocation. So M1 is a great brokerage for what you're trying to accomplish. And it's a good mix in my opinion. Okay, so should you have more or less? I think we'll take a look at that here in a second, but I think 46 with M1 Finance is fine. If you have another brokerage like Robinhood, Fidelity, Schwab, I think 46 is a lot. I think it's a little bit more difficult to manage 46 holdings in a different brokerage, and I would start out slow, and that's my opinion. For example, in my Vanguard account, I only have around 10 or 11, and it's easy to manage, but I don't know. That's just my opinion. Would you make any changes to the target percentage? All right, well, let's take a look at your portfolio. All right, let's take a look at your portfolio. I may bounce back and forth to the questions just to make sure that I touch on all of them. You got 46 holdings. You have it set up based off of the sector. You got real estate, healthcare, finance, utilities, consumer defensive. Okay, so you said that this is in your taxable account. So I guess really the big question here, Richard, is when are you looking to use your dividend, to tap into your dividends? If you're looking to tap into your dividends in the next 10 years, this is greatly going to differ than if you were to tap into them into 30 years. So you said that you're 22, you're investing about $150 a month into this. So I'm going to take the assumption that you're looking to tap into this in 20 plus years. So by the time you're 40 plus, maybe you're mid 40s. Okay, so I'm going to make that assumption that in your mid 40s, that's when you would like to start tapping into this, at least to pay for part of your living expenses. So you have real estate here at 15%. Let's see what you have in real estate. You have Realty Income Store, Simon. Okay, so you have a lot of exposure to retail. I think 80% is in retail. My first suggestion here is to broaden your exposure to real estate. So the way that it works with the real estate investment trust is very similar to the broader market, how you have different sectors, right? You have consumer, healthcare, materials, all of that. It's the same way pretty much set up in real estate. Right. I've made videos on investing into REITs on my channel. You can check out that video. But what I would recommend you do, limit your exposure to just one sector in real estate. So as a consumer, when we think about real estate, we usually think about what we see, right? What we see in front of us. That would be the grocery store, that would be the shopping mall, right? With Simon Property, right? The shopping center. Or for example, you're going to Walgreens or CVS. That's something that we see as a consumer. What we don't typically see as a consumer are your cell towers or big industrial warehouses. You can also invest into companies that own those type of buildings. So that's what I would recommend, is look at different types of REITs and not just have all of your exposure, all of your eggs in one basket into retail. Some of my favorite REITs that I like that you can take a look at are cell towers like AMT. I really like data centers like DLR. I really like public storage units like Public Storage or Extra Space Storage. Those type of REITs are really ones that I like. And also, I'm a big fan of real estate investment trust ETFs. VNQ is my favorite from Vanguard. So you can take a look at some of those. Let's take a look at your healthcare services. And really quick, when it comes to your percentages here, I think it's okay. You may even consider bumping up technology a little bit more, considering your time horizon. I think you could. I would even recommend that you would bump up technology. Just at a glance here, you could then lower. You could maybe lower utilities, maybe lower healthcare. I think, that's what I would say. I would say lower utilities, lower healthcare, a few percentage points, and then bump up technology a bit. All right, let's look at your health services. You got Johnson & Johnson, Pfizer, Amgen, AbbVie. These are all really good companies. The majority of these I own in my own portfolio. I think these are fine. The way that I have it set up, I have Johnson & Johnson weighted a little bit heavier. I think Johnson & Johnson is a much higher quality dividend growth stock than some of these others. Like for example, MDT is a great dividend growth ETF, and this really depends on your time horizon. Okay, so with MDT has a just over a 2% dividend yield. It's a great dividend growth company. If you look at AbbVie, for example, it has just under a 5% dividend yield. Now, AbbVie is kind of an outlier, but if you look at others, like for example, Pfizer would be a better example, where Pfizer is not growing nearly as fast as MDT, but it has a higher starting yield. And so that's what you need to look at is, what is your time horizon and what would you preference to have in your portfolio? So I guess kind of a rule of thumb that I follow, if you're looking to retire within 10 years, you want to go for a higher current yield. You would then therefore want to have a higher allocation into Pfizer and AbbVie, and then a lower allocation in MDT. Now, if your time horizon is 20 plus years, then you want to flip that. Then you want to have a higher allocation, in my opinion, in MDT. That's just kind of how that would work, given your time horizon. Looking at finance, you have a few banks here in Canada. These are really, really good. I like seeing Aflac, T. Rowe. These are all in my portfolio. Yeah, these are good. I think with banks, I think spreading it out equally is good. When it comes to the overall target allocation, I think you could even lower that as well. I think you could even lower finance and bump up the cyclicals or technology from that. Utilities, you got a high starting yield. You got Dominion, Southern, Duke, Consolidated Edison, and NextEra Energy. I own all of these in my portfolio. These are all great. With your time horizon, this is a clear answer, a clear, what I would recommend is put NextEra Energy at the highest target allocation. NextEra Energy. Consumer defensive, what do you got in here? You got Pepsi, you got Walgreens, Procter & Gamble, Coke, Target, Kimberly-Clark, Comcast. Kind of is actually a telecom company, but it does have consumer-facing part to it as well. Walmart and Costco. These are all really, really good. Pepsi, yeah. These are really, really good. I like these. Technology. What do you got in here? You got Microsoft and Apple. You can't really go wrong with Microsoft and Apple. Microsoft and Apple are great. What I work in the technology sector. I work in software, and so it's difficult for me to forecast who's going to win and who's going to lose, who's going to disrupt who, and etc. I really like investing into the Vanguard Information Technology ETF. It's VGT. So something, if you were to add to technology, you wanted to add a little bit more exposure to the overall sector, take a look at ticker symbol VGT. Consumer cyclical, what do you got in here? You got Home Depot, Genuine Parts, Disney, Sonico. This is a material company. But also a great company I own in my portfolio, Leg & Platt and Nike. Yeah, these are good. Yeah, these are really good. Telecom, what do you got in here? AT&T and Verizon, great. And industrials. Waste management, Lockheed Martin, Caterpillar, and 3M. Perfect. This is great. I really like how you have it set up. There's not much that I would really change there. All right, Richard, I really like your portfolio. I think you have a high starting yield. You don't have any ETFs in your portfolio. 46 is a manageable amount. You have decent performance over the last 5 years. This is not including the reinvestment of dividends. I think, you do have a high starting yield. I mean, with your time horizon, once again, assuming that you're going to retire in your 40s, you could even focus more on growth and sacrifice the current yield. And over the long run, you're actually going to perform better in the long run. And the reason why this is the yield on cost. Your yield on cost is going to be growing because you have such a long time ahead of you for your investments to compound and to grow. So I guess as a rule of thumb, what I like to look at, once again, is if you're in your 20s, look at more growth-oriented sectors and companies that are growing, in sectors that are growing. I think the big red flag that I have for you, something that I would highly recommend you reevaluate is your real estate slice. Your real estate slice is very risky. It's the holdings in here, these are good companies, but there's way too much exposure to them, in my opinion. So once again, take a look at your real estate portfolio, the slice here. And I think what would make your life a lot easier is to add in just one or two one ETF, and then one of those hyper growth companies that I was talking about, either DLR or AMT. I hope that this was helpful. Thank you again, Richard, for sending this over. And great job. All right, the next portfolio here is going to be from Dan. Dan writes, "Dear Dividend Growth Investing, enjoying your YouTube videos and have learned a great deal." Thank you so much, Dan. I appreciate it. I'd love to hear your thoughts on my non-retirement taxable dividend portfolio. Okay, so backward information. I am 46 years old. The goal is dividend growth and income. Measurable benchmarks for this goal include to incrementally grow my dividend portfolio to generate dividend income, to first cover a utility bill, then a car payment, and then possible rent to build a portfolio of passive income. We'll reinvest the dividends, but use this as a benchmark. Dan, this is such a great idea. When you're making this tangible, where you're saying, okay, I want my dividends to pay for a specific expense in my life, I think that is great. And the reason why, for example, is the psychological benefit that comes with that, right? A lot of us are focusing so far in the future. We're trying to swallow an elephant whole, and that's really not possible for a lot of us. And so in my career as well, I work in sales. And so we're not in a transactional business where we sell, just make sales every single day. It's more strategic and long-term, and it can go over 6 months, a year. And so it's important to stay motivated. That when I talk about with my team is that you have to celebrate small wins, because that's what's going to keep you going, keep you motivated. And this would relate to this. You're celebrating a small win. When you realize that, hey, my dividends can fully pay for my car payment, that is huge, right? So really, really great call out here, Dan. Second here, you're saying focusing on increasing monthly dividend over time. Great, so you're setting yourself goals. Holding largely ETFs with a handful of stocks that have a good dividend growth and strong dividend payment history. Okay, great. I also have another taxable growth portfolio with Wealthfront, risk score 10, that I use for growth. And I do have this activated for tax loss harvesting. Okay, so you're a little bit more experienced than a lot of the viewers here on the channel. It may seem like. This prevents me from holding some common dividend ETFs like VIG, DVY, and SCHD. I also have retirement accounts as well. All right, let's take a look at your portfolio here. So you got your highest allocation is in DIA. This follows the Dow index, and it pays monthly. Okay. All right, Dan, let's take a look at it and see what your portfolio looks like here in M1 Finance with all the numbers. You got 15 holdings. The dividend is just over 3%. You have a decent expense ratio. It's not crazy out of control, but it's not as low as it could be. Let's see, so there are some monthly payers in here. You got the most in DIA. Yeah, I mean, this could work. I think the most important thing with this strategy here is you're still getting a good dividend yield. You're not going over crazy with all of the holdings that you have in here. DIA is paying just over a 2% dividend yield. Yeah, this is a good ETF. DGRO, this is a really good high quality dividend growth ETF. The reason why I like DGRW is it's very different than all other dividend growth ETFs, because traditionally ETFs look backward looking, look at the last 5 years, 10 years, and 20 years of dividend payout from companies. DGRW looks at the potential of future growth. So it's a lot more skewed towards the technology sector. So that's where you're really getting the growth from DGRW. I've done a video on DGRW in the past, and I really like it. All right, so let's see. So I think the most important thing here with this portfolio is that you know your goals. You're 47 years old, and if you know that you're looking to retire in the next 10 years and what you're trying to accomplish, I think that's what the most important thing is all about. So Dan, thank you so much for sending over your portfolio. I think you know what you're doing. I'm excited that you're investing and you're doing this. Great job, man. All right, let's take a look at the next one here. The next one is from David. David writes, "Good afternoon. I've been a fan for a little while now. Love the pacing and detail you use for your portfolio reviews. Below is the link to my M1 Roth IRA. Hey, thank you, David. I appreciate that. Recently, I divested myself of most small cap value stocks, VBR, and total market index, VTI, and chose to remain with high quality individual stocks of companies that I understand and use. The reason for this is related to the high debt levels and layoffs of many smaller companies, especially with COVID. You're absolutely right. Additionally, I hold many of these small cap value stocks and ETFs in my taxable account. I realize they can produce outsized gains when the market turns around, but that will be handled by my other accounts. Okay, I'm looking for stability and longevity in my Roth. Okay, great. You continue writing here. To protect against inflation and Fed action, I added some gold and braced for a drop with short and intermediate and long treasury bonds. Okay, the long-term treasuries should help in the current low interest rate environment and vice versa when rates turn back up. Okay, so it looks like you're really trying to invest based off of what's going on in the micro and the macro environment that we're in here in the economy. I look forward to hearing back from you. For background, I'm 33 years old and hold a U.S. government job. I have a 401k through the TSP program, also a Roth, and a taxable account with Schwab that contains VXUS, VBR, and SCHB. All right, this is great. All right, so VXUS is a great international one. The Schwab is SCHB is just like VTI. All right, cool. So David, let's take a look at your portfolio. Your portfolio, you're up almost 100% over the last 5 years. So you're definitely in growth. You can see that also by the low dividend yield. You have a small expense ratio and you have 19 holdings. And you said that this is in your Roth. So if this is in your Roth, that means you're looking to tap into this in over 25 years. So you have over 25 years of growth in this portfolio. So that's a long time for your portfolio to compound and everything. Let's take a look at this. This looks really interesting. So you got a slice dedicated to individual stocks. You got the S&P 500. You have a treasury bond. You have more treasury bonds, more bonds, and you have gold. Okay, you have a lot of exposure to bonds. Now, my initial thought here is, yes, it's better to hold bonds in a tax sheltered account like a Roth. That's absolutely what you should do. However, the only reason why I could understand or imagine having so much exposure to bonds is if you are planning on timing the market or adapting to the market, which it kind of sounds from your email what you're trying to do, so that you can rebalance. That's the only reason why I could see having bonds in your portfolio in this account at your age. So that when the market drops 20 to 30%, you then rebalance. I mean, that's a fair strategy. I think that's what most people try to do, and there's nothing wrong with that. That's what I'm trying to understand. If that's not your strategy, if you plan to keep these and not rebalance and sell out of them and buy into equities when the market goes down, then I think you're missing out on the miracle of compounding in your portfolio. So with VOO, this is great. Let's take a look at some of your individual holdings that you have in your portfolio. Let's see, you're up over 200%. Insane. Okay, so you definitely have some growth in here. All right, so you got Walmart, Pepsi, Adobe, Microsoft, Apple, Amazon, Visa, MasterCard. All right, so every single one of these does incredibly well in the environment that we're in. Like, this is like the anti-COVID portfolio right here. Like, this portfolio is just a massive growth portfolio. This portfolio is going to do well, incredibly well. This is going to just destroy the S&P 500. Okay, so at least in the current times that we have right now, like this portfolio, this is an amazing portfolio. You got Netflix in here. Yeah, it doesn't pay a dividend, but this is a growth portfolio. It's in a tax sheltered portfolio, right? If you wanted, let's say fast forward 20 years, Netflix takes over the world. They're up 1,000%. You could sell Netflix and then you could buy Johnson & Johnson, right? And you're not going to pay any taxes on the capital gains because it's in a Roth IRA. You know what you're doing here. This is great. I was just talking about AMT earlier. I was just talking about DLR earlier. These are great. These are great REITs. If you're going to hold any REITs in here, these are definitely high quality. Hey, this portfolio, this is a growth portfolio, and I like it. I actually really, really like it. There are a lot of brands in here. These companies are going to be around for a while. Okay. Now, just looking at, for example, with Adobe. You look at Adobe 5 years ago. Adobe's market cap compared to its peers like Salesforce and others, it was just a little baby compared to these other software companies. Now it's one of the largest software companies in the world. Absolutely incredible. Okay. So there's a lot of growth in here. I think now when we talk about just living off of the dividends in your portfolio, you're in the position where this portfolio is going to be a multi-million-dollar portfolio. And because it's in a tax sheltered account, what you could do is, and I don't like talking about this because what I'm talking about now is timing the market, and I actually am against timing the market. But with this strategy, and I've also said many times, and you can quote me, there's many roads that lead to success. In this type of strategy, you know, if all things remain constant, past returns are no guarantee of future returns, but if things remain constant and in 25 years, your portfolio is up to $3 million or $2 million, you can then, if you wanted to live off of just income from your dividends, you could sell out of these other stocks and invest into higher quality, high yielding ETFs. That's what you could do, or dividend companies, right? So I typically don't like talking about that because it involves timing the market, and I'm not a fan of that. But if it, it can work very, very well. So I really like the portfolio. I love the companies that are in here. Wow, this is great. Also, just a side note here that I was just thinking about. My wife actually invests in a similar fashion. Not completely, like for example, with Adobe, she doesn't invest in Adobe, she invests into Salesforce. As an example, she also invests into Amazon and other hyper growth companies like that. But this is an overall really great portfolio. So great job, David. Thank you for sending over your portfolio. All right, let's take a look at the last portfolio. Last portfolio is going to be from Brian. Brian writes, "Hi Jake, my name is Brian. I recently found your channel and love it." Thank you so much, Brian. I appreciate it. It's great to see so many YouTubers documenting their dividend journey and putting the information out there to inspire others. I was wondering if you'd mind reviewing my portfolio on one of your videos. To give you a little background, I have a day job as a graphic designer, and I have my own photography business on the side. So you're side hustling. Great. I'm currently putting about $1,000 a month into my dividend portfolio, as well as a lot of my photography income. The thing that I love about photography and having side hustles like that is they can grow exponentially over time. Like they can scale quickly. I really like that. In comparison to I think Grubhub and these other, service side hustles that you can do are great, but you only have so much time in the day. But with photography, I think if you do it right, there's a lot more growth opportunity there. So really cool. I started my dividend journey in late 2018, and while the portfolio has changed quite a bit, I'm promoting quality over quantity. I couldn't agree more, especially with everything that is going on in 2020. The portfolio is currently about $40,000 and is creating $1,335 a year in dividend income at a 3.3% yield. It's a good yield. I wish my portfolio were on M1 Finance to make it easier, but for you, I have it through Fidelity and track it through Spreadsheet in Apple Numbers. So I've attached a screenshot. This tab merely shows the holdings, and I have other tabs that have various charts and metrics. Interested to hear your thoughts. Well, Brian, thank you so much for sending this over. I think you sent me another email as well with more information. I'll check that out in a second. But what you can do is, if you don't have M1 Finance, let's say you don't want to invest with it, that's completely fine. You can sign up to M1 Finance if you want, and without even funding the portfolio, but you can still play around and build your pies without even putting money into the portfolio. It's really cool. I actually did that myself before I transferred over from Robinhood, because I'll be honest, I was a little bit skeptical. This was last year. I was doing some research on and I was also skeptical with Robinhood in the beginning. I was on TD Ameritrade, Scottrade, and I tried it out. And so I first set up the portfolio in M1 Finance. I didn't fund it yet because I wanted to see, okay, can I even, maneuver around with it? Is it something that I want to use? And then after a while, after using it and figuring out the platform, I then funded, I think it was like $1,000 or something like that. And then I started using it more. So that's something that you could do. You also sent me a second email here around a little bit more information. So Brian, you wrote, I'm currently 34 and my goal is to be able to retire off of dividends in by 45 to 50 years old. We are in a really similar situation. I'm using the dividends to build a stream of passive income while my wife and I are working on paying off our house early so we can get some investment properties and add even more passive income. The ultimate goal for the dividend portfolio is to make $100,000 a year in passive income. Wow, Brian, this is amazing, man. All right, so let's take a look at some of the tickers that you got here. You got Apple, you got AbbVie, you got Aflac, Caterpillar, Colgate, Chevron. A lot of these are dividend aristocrats. Some are even dividend kings. You have it fairly set up by sector. I'd like to know the percentages of what's in technology, what's in healthcare, what's in consumer discretionary. I guess we can look at the value amount. What's got the highest value amount? It's fairly diversified. Looks like you have the most in Microsoft. I'm curious with Microsoft, how much of that is the cost basis versus the value? So you have the reason why it's the highest value is because you have the highest cost basis. You've invested the most. So you probably have just recently invested in it. That's why the cost basis is so high. Also with Realty Income, okay, this is actually a higher one. Kimberly-Clark looks like it's your highest holding. Now this is a good one as well. What's the, okay, so this one is the one that you're funding the most. I guess, are the darker ones the ones that you're funding the most right now? They're the ones that have the closest cost basis to value. Okay, cool. So you have some really high quality companies in there. You also have some growth. You got Visa down there at the bottom. You got Target, but you also have higher current yielding ones with AT&T. AT&T is, okay, so you got a higher cost basis with AT&T. That's fine. You can average down. It's a great company. You got Nike in there. You got NextEra Energy. Hey, you have some really, really high quality companies in here. Okay, and so you said that your average portfolio, I'm assuming this is the weighted average. The weighted average is 3.3% of your overall portfolio. This is a really good yield. So it sounds like you're kind of in the similar scenario as I am, my wife and I, where you're 34 years old, you're looking to retire in your late 40s. What you want to focus on is a dividend yield between 3.25 and 3.5%. That's your sweet spot. Okay, that's what you want to focus on. And also for looking just at the dividend growth, you want to look at something around 7, if possible, 10%. There's not a lot of them, but between 7 and 10%, a company or an investment that is growing its dividend between 7 to 10% year over year. If you do that, you're going to be able to reach financial independence and retire off of your dividend income. Hey, this is so exciting. I am so happy for you. It's kind of like looking in the mirror. This is what my wife and I are trying to accomplish as well. I think you know what you're doing. It's so cool to see how you have it broken up in your spreadsheet here. Thank you so much again for sending this over. Thank you once again, everybody that has sent over your portfolio for me to review. Once again, if you've sent over your portfolio in the past, I have it in my inbox. There's a lot of you that have sent in your portfolios, and it's been a couple of weeks now, and I just want to let you know that I've not forgotten you. I have your email in my inbox, and I will be reviewing your portfolio in a future video. So please be patient with me. Also, if you would like me to review your portfolio in a future video, shoot me over an email in the description below. Add a little bit of context, who you are, your goals, your age, all of that fun stuff, so I can tailor it and personalize the review to you personally. Once again, As always, not financial advice. Thank you so much everybody for watching the video. If you liked today's video, give me a thumbs up and I will catch everybody in the next video.